Good afternoon, everybody. Welcome to the DFL program with Senior Analyst and Agency Director Scott Forehand. My name is Tom Deutsch, Director George and Janet Matthews, and DFL is short for Debt Free Life. It's a program that Symmetry Financial Group created in order to help families reduce their debt to zero while building wealth at the same time. Our mantra is now $1 trillion, $1 trillion of consumer debt retired. Scott, I just have brag a little bit. I had a fantastic call last night with one of my clients and one of his business partners. Looks like I'm going to be working on two cases for business owners. It'll be my first ones. So I might be giving you a call, asking you for some advice on that. But
Anytime,
without any further ado, Scott, thank you so much for making the time and appreciate you very much.
Thank you for the very kind words. Thanks for the intro, Mr. Deutsch. Pleasure to be working with you as always. So my name is Scott Forehand. I'm an agency director, as Tom said, here at Symmetry Financial Group. And the focus and conversation that we're going to have today is about the Debt Free Life program, which is a proprietary program offered by Symmetry Financial Group. Just real quick, as a brief history of Debt Free Life. This is not a new concept. It's been around for a long time. Actually, the initial concept of infinite banking, before it was even called infinite banking, has been around going back over 100 years. So the concept is not new. The vehicles that we use to perform what it's supposed to do are new. And there's been several iterations of these programs as we've gone through time. I'm not going to name any of them because all the ones that have come before us have failed at one point or another. So there's no reason to advertise a failing product. But I can tell you that we did take into consideration when Symmetry came out with this program, we did take into consideration the reasons why those other programs fail or failed. And we built in stop gaps to prevent that from happening with the Debt Free Life program. And as we go through this presentation, I will be happy to point out those things that we've done to keep it from failing. So if, let's see everybody. Okay, very good. So let's go ahead and get started. And here we go. First off, Debt Free Life, I just explained what it is. It's a proprietary program from Symmetry Financial Group. Nothing that, if you've been on any of these presentations before, you've always heard that. So looking at the Debt Free Life piece, these are the two primary questions that we are taught to ask when we're looking at a Debt Free Life program. Are you 100% sure you're going to have a great retirement, or do you have some doubt? And I'm going to tell you right now that if your retirement program or your retirement plan involves any kind of an IRA or 401k, then you should have some serious doubt about the efficacy and capacity for your retirement program to do what it's supposed to do for you. And the second thing I want to say is the second question we always ask is if we can show you a way to get out of debt in 9 years or less, including your mortgage. Would you, without you spending any more money, would you be interested in listening? And of course, hopefully that's one of the reasons why you're here. What I find is, as we've done, my team has done hundreds of these programs, if not, I don't know that we're at 1,000 yet, but we're up there. The reality is it's not just 9 years or less. It's actually based on the length of time the individual has debt or debt planned, and the amount of debt service they're able to support. So really, rather than saying 9 years or less, I would say 15 to 27 years early. This program does work for anybody with any debt. And in some cases, for people that don't have any debt, that's a good thing. The program still works. It's just not a debt-free life program at that point. It's actually a pure financial retirement program. And we'll talk about that in a few minutes. All right, moving on. So most people, if you're an American, this is about what you end up with at some point in your life. This is how your money is spent. And I'm no different. I've done a debt-free life program. My wife and I have done one now. Most of my family has done one now. And this is pretty much the standard. We're taught from a very early age, it's okay to take on debt, which is why when we get to where we are now in our 30s, 40s, 50s, 60s, we are in this situation where we're able to maintain our debt service. But now we're just trying to get back to zero. Now we're trying to get all of our debt eliminated so that when we retire and we have a 40% drop in income, that we're able to support ourselves. What we're going to do at Debt Free Life is we're going to show you how to increase your lifestyle money. That's your spending money. We're going to show you how to decrease the amount you pay in taxes. We're going to show you how to decrease the amount you spend on interest. And here's the key thing here is we're going to show you how to really, really soup up or ramp up your retirement savings significantly. And what I mean by that is, we're going to show you how to increase your retirement savings by about 500%. So if you're like most Americans, this probably represents you. Over the course of your life, you're going to generate about $2 million in income. That's a lot of money. The problem is that we're not taught how to save it correctly or how to use it correctly. And that's what debt-free life is. It's a fundamental change in the way you spend money. Okay. If you are accustomed to making a good living, and let's say it's $60,000, $70,000, $80,000 a year, and you're the standard American, normal American, when you retire, you're going to have about a 60%, maybe 40% drop in income. But you're only going to have about $60,000 saved. How long is that going to last? And this is one of the biggest concerns that we hear when we're talking to folks about these debt-free life programs and about their financial future. They have a concern that they're going to outlive their money. That's the number one cause of concern for people that are looking at retirement. Am I going to outlive my money? And what I'm going to tell you is, if you use a debt-free life program and you structure it correctly, the answer is no. You will not outlive your money. You can't outlive your money. Okay. So moving on. So where you are right now, traditional American, if you talk to people and you have a significant amount of debt, then maybe you talk to a debt counselor, a debt consolidator, someone, a debt negotiator, and they're going to give you these options. They're going to tell you to go get a second job, spend less money, eat ramen and tuna fish, refinance your debt. The only one of those recommendations that typically work from those individuals is the debt snowball. And that's only if you're doing a true debt snowball and not really a debt stack, which we'll talk about later. But the point is that most of those people who are going to tell you how to consolidate your debt, manage your debt, eliminate your debt, write off your debt, most of those people are not showing you the whole picture, and they're telling you something that's an incomplete truth, or at least partially inaccurate. What we're going to do is this: show you a better way, and we're going to move you from the traditional American on the left side of your screen to what it looks like when you're using a debt-free life program. We're going to increase the amount of money you've got for your lifestyle, meaning without you spending any more money, without you going out and getting a second job, without you having to borrow money from Uncle Bob. You're going to make the same amount of money. They're going to pay the same amount of money. It's just at the end of the day, you're going to have more money left over. How do we do that? It's because we're changing the pie chart. We're changing what you're spending. Instead of you spending 40% of your money to support your taxes, we're going to change that to 30%. Instead of you spending 33% or 23% of your money in your lifestyle, we're going to increase that to 33% of your dollar. Instead of you saving only 3% of your income, we're going to move that up to 15% of your income, which is what I was talking about before, 500% increase the amount of money you're saving. And we're going to significantly reduce the amount of interest that you pay over time. We're going to do that by a couple of different things. Primarily, we're going to reduce the interest that you pay to lenders simply by eliminating those debts faster than you ever thought possible. We're going to reduce the taxes you pay over time by limiting the way that you take money so that it's not taxable. We're going to improve your cash flow. Once you've got your debts eliminated and you've got this bigger, larger, more robust retirement built, then you can have more of that money to do whatever you want to do with it. And finally, and this is the key to a DFL program, debt-free life program, we're going to allow you to retire with the most favorable of incomes, with the most favorable way you tax an income, which for me, the most favorable way to be taxed on my income is to not be taxed on my income, to have zero tax. And that's what we're going to show you how to do. Moving on. One of the main reasons why those programs that came before us failed, there's about 10 core reasons why they failed. And when we started looking at those other programs and specifically why they were failing, we built in, this is what I said before, we built in stopgaps into a DFL program to prevent those from failing. And the number one reason why those programs failed earlier is because they did not have an emergency fund built in. And what do I mean by that? I mean, there's a specific amount of money in these programs that's going to be hidden from you. It's not because we're trying to hide stuff from you. It's just because we don't want you to have easy access to it. If it's out of sight, it's out of mind. So when I'm looking at specifically that emergency fund, what I'm looking at is about 20%. So even though you're going to have the ability to go into your online portal and see what kind of funds you have available and see what kind of loans you can take, there's still about 20% more. And the reason why we do it, again, we want it to be painful if you're going to touch that 20%. It needs to be a true emergency. And just to give you a glimpse of what I mean by that, I mean, if you actually decide to tap into your emergency fund associated with these programs, what you're actually going to be doing is canceling your program. And if you get to the point where the things are a true emergency and you really, really need the money, then canceling your program is probably appropriate. But most of the time, the quote unquote emergencies are not really emergencies. All right, let's move on a little bit. So one of the things that I like to look at is it's called min-maxing. And that's what I do is what I look at is what's the minimum amount of thing, whatever it is that I need to do to get the maximal amount of gain. Okay. So if I need to hit a golf ball, what's the minimum amount of effort I need to do to hit that golf ball? And that's because I'm going to use a driver. I'm not going to use my putter to drive. If I'm a football player, what's the minimum amount of effort I'm going to do as a quarterback? Well, I'm going to hand it to the running back and let the running back go off with it. All I'm doing is passing it away. So the idea here is I want to do the minimum amount of work to get the maximum amount of gain. And the way I do that is by using the program that is the most tax advantaged program. If I put money into a savings account, I'm going to pay taxes. I'm going to get a very low return. And that's what that tax return column is. That's that $41,900. All three of these numbers that you're looking at assume a $10,000 investment. All three of these numbers that you're looking at assume a 28-year run. All three of these assume a 7% interest rate that I'm getting from the market. And all three of these assume a 25% tax rate, which I'm going to show you a little bit later on. That's probably light. So when I'm looking at that, I'm looking at these numbers, I'm looking at the tax rate. Then when I compare a savings account based retirement program at 41.9 using the same $10,000 investment, an IRA based program at 49,866, that's tax deferred. It means I'm not paying tax on it now, but I am paying tax on it later. And when I'm growing my nest egg in the taxed account, tax deferred account, that means I'm also growing the taxed amount. So when it comes out later, I'm growing the tax too. And then finally, a debt-free life program. This differs significantly from a Roth IRA. Okay, Roth IRAs, you're going to have in theory, tax-free retirement program with a Roth IRA, but you're still going to be limited as far as when you can take the money, what you can take the money for, how you access it. And certainly the IRS is still going to be able to tax some of it potentially. So when I'm comparing a tax-free solution versus a partially tax-free solution, again, the number is going to come out better here with the participating whole life, which is what we use as a core for these policies. And these numbers, this is not magic. It's just math, and this is the way the math works, and it works. So if I have that same $10,000 investment, if I invested in put it in my savings account, I'm going to have 41.9 in 28 years. If I put it in my IRA after I pay my taxes when I take it out, I'm going to have 49.8. And if I put it into my debt-free life program, I'm going to have 66.4. It's a no-brainer. Same $10,000 investment, same length of time, same interest rate, same tax rate. It's a no-brainer. Let's move forward. Like all financial instruments, and don't have any illusions, debt-free life, even though it's life insurance, it is still a financial instrument. Like all financial instruments, it works in phases. And you can enter in a financial instrument at different phases in your life. So the first phase we call the maximization phase. And the reason why we call it the maximization phase is because the purpose, goal, and focus during that phase of the application of a debt-free life program is to eliminate your debt as quickly as possible. Because the long-ranging result of having early debt elimination puts you in a situation where you can save more money, you can eliminate interest, and you can put yourself in a position, if you're using one of these programs, where the more money that you're saving becomes a tax-free savings, becomes a tax-free event when you pull it out. Once you get out of the debt elimination phase, which we call the maximization phase again, once you get out of that, you've entered into the accumulation phase. So this is something I was saying earlier. You have people that maybe they don't have any debt, or maybe the only debt they have is a mortgage. In that case, all that means is they're going to be hitting the accumulation phase at a different time. If you don't have any debt, that means you're starting in the accumulation phase, which that's great. That means you are really supersizing your retirement from day one. There's no problem. There's no downside for this. And I've worked with people that are multimillionaires, and they are doing this starting at the accumulation phase. It's a no-brainer. And then finally, when we get out of the accumulation phase, what that means is we're no longer paying for the program, or the program is now on autopilot, completely self-supporting. At that point, I've entered the distribution phase. And what that means is I can take the money and do whatever I want to do with it. It's my money. I'm the banker. I'm the controller. I decide if I want to lend myself money. And if it's an appropriate reason, like going up to see my good friends in Hopewell, Virginia, or maybe heading down to Tallahassee, Florida, because I just want to go see one of our colleagues, that's fine. In the distribution phase, that's fine. Okay. But if you're not in the distribution phase and you decide maybe I need a new jet ski or I need a new Jeep, you need to make sure you're spending the money for the right reasons. Let's move on. Okay, next. This is, like I said, this is not a new scenario. This has been around for over 100 years. And there's a couple of the people that have done it in the past and are still doing it today with Warren Buffett. So the idea here is that it's a tried and true process. They did not use the same vehicle that we're using simply because it wasn't available to them, or because they didn't have to use the vehicle we have. For example, previously, when Ray Kroc was doing this, you could set one of these programs up with one of the three carriers at that time that was doing it, but you had to have a significant amount of money to put on deposit to start. You had to have over $1 million. And Walt Disney, same deal, over $1 million. He started with 10. So this is not new. It's just, it was something that was available really only to the wealthiest segment of the population previously. And then thanks to Symmetry Financial Group and the powers that be, they actually created and rolled this program out in 2019 and got it approved in all 50 states. So let's move on. I've already talked about this to a limited degree. Pay off your debt 9 years or less. No, it's actually 15 to 27 years early. Inefficiently used dollars. And this is a key thing I want everybody to consider. What's an inefficiently spent dollar? And I'm going to say this. If you have a credit card and you decide that $50 credit card minimum payment per month, you want to get rid of that credit card fast, and you're spending an extra $50 a month to pay that credit card off fast, is that an efficient use of your money? And the answer is no, absolutely not. Because what that means is as soon as you spend that $50, it's gone forever. We'll show you that in a minute. Policy cash value. This is where we're talking about that nest egg that we're building, that huge number where the previous slide showed $41,900 in a savings account versus $66,000 and change in our debt-free life program. This is the difference where the money's growing. It's growing because you're paying into the program, and it's growing because of the income, because of the application of a guaranteed interest rate plus a dividend that happens on top. So, and then finally, at the end of this, let's talk about that for a second. This program is designed to create what we call generational wealth. It's designed to transfer wealth from you to maybe your next generation, your children, or maybe your 2 generations down the line, your grandchildren, or maybe even later to your great-grandchildren. This is something that's been done with the wealthiest segment of our population for the last 150 years. This is not new. The concept is not new. It's the way that they do it. And because we're transferring this wealth through the use of a life insurance vehicle, we're going to eliminate some potential IRS taxation issues. So when we first started this program, that's kind of what we were looking at: elimination of debts, 84,000, 73,000, 100,000, paying things off. Those numbers from the things that I'm seeing these days, that's actually very light. And we're looking at the traditional client that we're looking at has somewhere between $300,000 and $600,000 worth of debt that we're eliminating, and we're eliminating it rather than in 30 years where most of them are. We're eliminating it in almost every time in less than 10 years. All right, so let's move on. So I said earlier that we were talking about how this is a fundamental change in the way you spend money. So let's look at the way you spend money. The way you currently spend money, Mr. Slingo, is you make the money. That money gets deposited as an income to your bank. That bank is happy to accept your money, and they're happy to lend your money out every night and make money with your money. And in the end, they decide they're going to keep the money they made with your money. And then eventually you're going to tell your bank that I need to pay my debt. And what do? I fill out my bill pay. I write a check, whatever it is. And then I tell them to pay my debt. And then what happens, Mr. Slingo? Your money has become their money. That money's gone from your bank. And what did you get from your bank for that? The only thing you got out of your bank for that was hey, because you put so much money in our bank, we're not going to charge you a fee to keep your money in our bank. That's it. Okay. And that's, for me, I understand that that's how they make money. The banks don't really own anything. They use your money. And they leverage your money. That's it. So what if we change the argument? What if we change the paradigm? And instead of you doing things the way that you've been taught, and you doing things the way that all of us were taught, really, instead of us using our money only one time, what if we change? And that's the debt-free life method. So the debt-free life method, you're going to make the same amount of money. You're going to deposit it, your income, right back into your bank. That doesn't change. That process doesn't change. This is where we have a departure from the norm, though. Instead of leaving our money in our bank account, we're going to actually make a life insurance premium payment. That's what this is. Remember, this is a specialized type of life insurance we call participating whole life. And what we're going to do is we're going to make that payment to our life insurance company. There's only 3 that do this, participating whole life. And when the money hits the carrier, hits our insurance company, they're going to split that money into 3 buckets. Okay. They're going to split into these 3 buckets: whole life, term life, and paid up additional life insurance. So whole life is the core policy. Term life is a rider on top of the whole life policy that does 2 things. Number one, it increases the face value of our life insurance. And the second thing it does is it creates an umbrella that shields the IRS from looking at what we're doing. And by doing that, we're making it so the IRS cannot make the determination that what we're doing is anything more than life insurance. It's shielding the amount of cash that we can grow in the program. And finally, that third bucket is the paid up additions. So let's talk about that for a second. So when I'm making that premium payment, let's make it nice and easy. Let's say that premium payment is $100. Okay. So I'm making a $100 payment. Of that $100 payment, about 21% is paying my whole life premium. About 11% is paying my term life premium. And about 68% is paying for my paid up additions. Now, this is significant because what this is, remember, it's participating whole life. What that means is I'm able to participate with the profits of the company, because all 3 companies that we do this with are called mutual companies. So in order for them to maintain their mutual company status, which is a tax advantaged status for the company, they have to give away some of their profits to their constituents, to their stockholders. And when you become insured by a mutual company, you become a stockholder in that company. Okay. So because you're a stockholder, they now are required to pay you a dividend. And remember, this is participating whole life. So not only are you participating with the payment of dividends, but you're also participating with a guaranteed interest rate. So what do? Let's recap. So we made our money, deposited our money into our checking account, made a premium payment from our checking account to our life insurance company. And what happened? We changed the argument. We have made it so that our money is no longer sitting in our checking account with the bank earning money every night on our money. We've actually moved our money through our checking account and created our private bank, our debt-free life bank. And in the process of doing that, we've also procured life insurance. We've procured a term life policy, which technically is insurance for that life insurance policy, so that the IRS can't tax us on this. And then the majority of the money that we're spending, 68%, is being paid into paid up additions. And now let me finish that discussion. Why is that important? Because the cash value that's hidden in the whole life policy, which is roughly 10% of what you pay, and the paid up additions, which is 68%, creates an amount of money that the carrier is using to invest. And because they're investing it, they're making money with it. And because they're making money with it, and because you're a shareholder, they're paying you a dividend on the money that they're using of yours. And they're also paying you a guaranteed interest rate on the money that they're using of yours. So really what we're looking at here is about 78% of every premium payment you pay is creating a cash amount that's being applied an interest rate and a dividend by the carrier on your behalf. All right, so let's move forward. So as we move forward, now it becomes time, it's time to pay a debt. Let's assume, so we've been paying, let's say we've been paying $100 a month for a year, and 68% of that are for 10 months. So 68% of that's going into our paid up additions. So we have $680 of paid up additional life insurance. We've got some hidden amount stored in the whole life. We've got a term life policy that's acting like an umbrella, shielding all this from the IRS. And now it comes time to pay a debt. So let's say we've got one of our credit cards, and through the course of making minimum payments, we've got it paid down to $500 that we owe. We've got $680 in our paid up additional life insurance. So now we say, okay, I want to pay that credit card off with that $500 payment. How do you do it? So you call the carrier, you go into your online portal, you fill out a form. It just depends on which carrier you're using. And you tell that carrier, hey, I want to take out $500 loan. I want to take out a $500 loan. So they do that. They take out the $500 loan and they deposit that back into your checking account. So this is a carrier loan. And then you go into your regular checking account, Bank of America, Wells Fargo, whoever it is, it doesn't matter. And you tell your bank account to pay your debt. And that debt is then transferred. The amount of money you told them to pay is now transferred to your creditor. And then your money has become their money, right? No. Where's your money? Your money is still sitting in your DFL bank. You did not use your money to pay that debt. You used a loan from the carrier. Is your creditor paid? Yes. Do they care where the money came from? Absolutely not. They just wanted to get their premium. So the carriers pay, the lender, the creditors paid, the money traveled in and out of your bank account. You sequestered it permanently in your debt-free life bank. You've still got that $500 in your bank. You used a carrier loan. You took a carrier loan at a really low interest rate. Worst case scenario that I see, the net interest rate is going to be 0.76%. And you've still got your $500 sitting in your private bank, in your debt-free life bank, earning a guaranteed interest rate plus a dividend. This is the fundamental change in the way you spend money. You're still going to pay your debts. This is what debt-free life is we are not debt consolidators. We are not debt negotiators. You're going to pay your debts, but in the process of paying your debts, we're going to use that debt to fund your debt-free life program. And you're going to be able to capture a large portion of that debt. So what I usually see is about 60 or 80%, somewhere between 60 and 80% of whatever debt you owe. If it's $10,000, at the end of paying off that $10,000 of the debt-free life program, you're probably going to have about $6,000 cash in your program. If you have a $100,000 mortgage, at the end of paying off that $100,000 mortgage with a debt-free life program, you're probably going to have about $60,000, somewhere between $60,000 and $80,000 of cash in your program. It's just the way the program works. So if you can have the cash and you can pay your debt, it's a win-win. Everything is working in your favor at that point. And not only have you sequestered that money simply because you put it up into your debt-free life bank for the first time, you've sequestered it forever and it's working for you forever. So let's see how one of these programs works in real life. So this is a family that I did. I just spoke with these folks about a week ago. These folks started their program in October of 2019. They had a significant amount of debt. It was a family. They had both been married previously. So there were 3 children, 2 on one side, 1 on the other. They both had houses before they came into this. They both had careers. The woman at this point in her life was actually working for her PhD, so had a tremendous amount of student loans. This is their life. And with the student loans are evil people. With the student loans that she had, that family was going to be in debt for 40 years. And what we did was we changed the argument. We made it so that their debts were working for them instead of against them. And when we showed them this screen, their true debt was not $584,000. That's how much their debt was if they were able to write a check today to pay off the debt. That wasn't the case. When you considered the amount of interest and debt service they were going to pay over time, the true debt was $767,000. So when we ran these numbers through the system for them and gave them a roadmap and a plan, this is what we came up with: 7.8 years. This is not them spending any more money than they were spending right at that time. They were going through the process like all of us do, where they were trying to pay off some debts. They were trying to pay off some faster than others. And when you think about this, most people think, I'm going to pay off the highest debt first, or some people will say, I'm going to pay off the highest interest rate debt first. You know, there's different ways to approach it, and almost always it's wrong. And that's what the software that we have shows us. It shows us the best way, the best order. There's only one possible combination of the amount of debt that you owe with the interest rate that you have and the order that you're going to pay it off. There's only one best solution. And the solution is the very expensive software that we have that shows us how to do that. So anyway, so for this particular family, we got them out of debt 32.2 years early. That means they had 32.2 years of additional time to build a retirement. And for the fact that the husband was only in his 30s, that's certainly enough time to build a retirement. So when we showed this to the husband and we showed this to the wife, this is the thing they saw. 40 years to get out of debt, paying $182,000 of interest with nothing left to show for it other than equity in their homes, versus 7.8 years to get out of debt, saving $70,000 in interest. And at the end of that 40-year run, having not only 100% equity in their home, but $4.8 million liquid cash in their program. And, oh, by the way, remember, it's life insurance. So there's a $1.1 million paid up life insurance policy on top of it. This is how it worked for them. This is pretty straightforward in the first 3 years. And this is what we see almost always when people have a significant number of debts, meaning more than 5 different debts. The least sizable debts are going to get paid off first, not necessarily the lowest interest rates, but the least sizable ones are going to be paid off first. They're almost always going to be paid off in 2 or 3 years. And that's going to be where that debt snowball is created, the true debt snowball. And then the larger debts, in this case, that $96,000 was a house, $68,000 in year 6, that was a student loan, and 117 was their primary residence. In this case, those 3 largest debts got paid off towards the end. So a couple of key things I want you guys to take away from this. First off, see year 4. In year 4, there was $91,000 at the end of the year left in their program. That means they had $91,000 cash, but they weren't able to pay any debt off at that point, because the way our software works, it only looks at when there's enough money to pay off the debt completely. Okay. On a different day, at a different time, we talk about chunking. That's not today. But in this scenario, just paying it off when there's enough money to pay the debt. At the end of year 4, we had $91,000, but the debt we owed, the smallest one we owed that we could pay off where it was going to make a significant difference, was $96,000. So in that scenario, we had to wait for a couple of months into year 4, which realistically, this was about year 36 to 40. So 4 months into the 4th year is when the amount of cash in our program was enough to meet the amount that we owed on that debt. And then we pulled the trigger and paid that debt off completely. Year 7, in year 7, we had the same issue. We only had $45,000 left in our bank because we've been doing what we call dollar cycling, where we're using the same dollar over and over and over, building up a loan, paying off the loan, building up a loan, paying off the loan. So dollar cycling allowed us to get to 123,000, but at that time there was not enough money to pay off our debt. So in the following year, we were able to take 117,000 from our program, and we had to come up with another 18,000. That came from a savings balance. See this column here, the savings balance column. that means that the debt-free life program was not large enough to capture all the cash that we wanted to put into it. So that means there had to be another vehicle that we were storing that money in, which in this case, $18,000 was stored in a savings account, as illustrated here. That's not what we're doing. There's actually a second bank. We'll talk about that later. But anyway, that's the result. So when we spoke with this gentleman at 36 years old, he wanted to retire when he was 70. So we, or 70, 75 actually. So we ran the program out to age 75. But what I showed him was that at age 55, he would be able to retire with $1.5 million cash in the bank. $1.5 million cash should yield about $75,000 a year in income, just through a normal investment. But with a debt-free life investment, if you look at the fact, assuming he retires at age 55, and at age 56, he would have added 21,200 to the program, but our program grew by more than 21,000. Our program grew by 136,000. So if you take off the 21 from 136, that means this program grew automatically without him investing any money. This program grew by $120,000+. So what we're doing here, by the age 55, not only did we create $1.5 million in investment, it's continuing to grow at 120,000 plus per year. All right, let's move on. So sometimes people will say, well, what if I don't have any major debts? What if I don't own a house? Well, here's an example of this. Yes.
Can you go back to that slide? I've got one quick question about that.
Okay, maybe.
The one that showed the. Okay, yeah, that one. So when in year 7, when he accumulated the 123 and you had to wait a couple months to actually pay off the 177.
Yep.
Is that showing that at the end of the year, having paid off that 177, at the end of that year, he had a positive value of 75,000?
All right, so let's look. So at the end of year 7, he had $123,000 in his bank.
Right.
Sometime during year 8, there is a need to pull 117 plus 18, $135,000 to pay off that house. Okay. So between the savings, loan from savings column, between 18,000 that came out of savings and 117,000 that came out of his bank, there was enough money to pay off that last debt. And what this column is showing, the end of year loan balance, that's showing the amount of loan from the previous year plus the amount of loan you took from this year that's not yet paid off.
So that 75,000 is what his liquidity gained back after paying off that loan.
So yeah, I mean, you can look at it as liquidity gained back, or you can look at it as all that is, that's the end of the year annual liquidity. Okay, so at the end of the year, if his calendar year is January 1 through December 31st, on December 31st, there would have been $75,000 still in his program available from the E&E, that's that emergency fund, $36,000 in an emergency fund,
okay,
and $39,000 in his actual bank.
Okay, so that's a combination. Okay, I understand.
Okay. All right. Let's move on to the next example, and then we'll be done with this presentation. All right. So this was a 23-year-old college student. This young woman had a significant amount of debt for being only 23 years old. The majority of it was student loans. And why is that, Lorene Breitkreutz? That's because student loans are evil, right? Student loans are evil. There's a common theme here. Student loans are evil. All right. So when we talked to her, she was on track to be out of debt in 40 years. Student loans, 40 years. And on that 40 years, she can continue being in debt for 40 years, or she can do it the debt-free life way and be out of debt in 9.7 years. And when we looked at her real debt, this is sick. This is why I say student loans are evil. The amount that she owed debt-wise was just pure debt, was less than the amount that she owed in interest. The amount that she was going to pay in scheduled interest. It's sick. So our program saved her not a lot, about $30-some thousand in interest, which is significant. Okay, but I mean, it's 1/3 of it saved her 2/3 of the interest she was going to pay. But more importantly, it got her out of debt faster so that she can start putting money into savings. So in 40 years on her current method, she was going to have nothing. She wasn't going to have equity in anything. It's just the debt was going to be eliminated. Whereas with this program, in the same 40-year period, paying the same amount of money she's paying now, she was going to have $603,000 in liquidity, not to mention a $400,000+ life insurance policy that was fully paid up. How's it look for her? Couple things here. We got her retired at age 55. All right, so that means that at age 56, she's no longer paying into the program. At age 56, the death benefit of $685,000 without her paying anything else. At age 56, the cash value of the program is $431,000. At age 56, the program is growing at $23,000 a year. If you look at tax brackets, look at income levels, $23,000 a year with taxes is about $35,000 a year in income. Okay, so essentially what we did for her is put her in a situation where she's going to have the equivalent of a $35,000 a year taxable income without spending any more money than she was already spending. So when we look at folks for DFL programs and we qualify them, the requirement to have a debt is not there. That's debt-free life is the name of the program, but it's a financial instrument, works in three categories: maximization, accumulation, distribution. So for people that don't have any debt, that's great. You're starting off with in the accumulation phase. For people that have some debt, it's actually going to work better. So here's a quick analysis. When I look at two people that have the same amount of debt, person A, $100,000 worth of debt, person B, $100,000 worth of debt. Person A's debt is that $100,000 they owe is because of only two debts: a car for $20,000 and a house for $80,000. Person B's debt is 7 debts. And by the way, that's the sweet spot for these programs. If you are here for looking at a DFL program for yourself and you have 7 debts, you're the perfect candidate. If your client that you've brought here, or the client that you want to talk to about this program, has 7 debts, they are the perfect candidate. The reason why is because we get that debt snowball built up. And the sooner you get that debt snowball, the faster the debt rolls off. Okay. So 2 people, same debt, $100,000 each. One person with 2 debts, they're going to have a good return. They're going to have a good result. They're going to be debt free in probably 12 to 15 years. The person with 7 debts, they're going to have a significantly better return, a significantly better result, and they're going to be out of debt in 9 years or less. Okay. That's all I want to say about that. So this is the end of the program for this basic presentation. The one thing I would say is, we already talked about what this young woman's going to have. Remember, well, I didn't say this. This person that was the focus of this particular illustration, this is a college student. She's in the master's program at Cal Poly in marine biology, and actually she's probably graduated at this point. This program for her was based on the affordability for a waitress. She was a server, and all she was able to afford $350 a month. So this is a $350 a month program that a college student can handle. Okay. So I have seen these programs work for as cheap as $65 a month for an 18-year-old. And I have seen them fly for 74-year-olds that make $25,000 a month that are retired military. So this work, there's everywhere in between. These are customizable based on your income level, your age, and your health. But pretty much everybody's eligible for these. And if you've got debt, here's the key. If you've got debt and you are currently making your debt service, you're able to support your debt, then this will work for you. If you're doing the shell game, borrowing money over here to pay off this debt and take it out a new 0% interest credit card, and then taking money off that and paying off, if that's what you're doing, this program will probably not work for you. Okay. But you need to be able to support your debt. And then we're going to go in, take a look at what you've got, figure out where you're overspending or where you're spending money inefficiently. That could be not just overpayment of your debts. It could be because you're contributing too much money to your 401k. It could be that you've got some life insurance out there that's inefficient life insurance. Let's say you got a $50,000 policy, but you're paying $100 a month for it. That's inefficient. So there's lots of different places where we can find the money that you're spending inefficiently. It's not just overpayment of debt. Okay. So with that being said, that's the end of this conversation, end of this presentation. So make sure that if you were invited here and you're not a Symmetry agent, that you get with whoever invited you here and have a conversation with them. Look at doing a debt-free life program, fill out one of those debt-free life financial analysis forms. And be honest, the more information and the more accurate information you give to your broker or underwriter, the better your program and the more accurate your program is going to be. And if you're an agent and this is your first or second or third or whatever exposure to this event or to debt-free life, go out and go help your families. This is a great program. So I'm going to go ahead and stop for a second. I'm going to go ahead and see there's a couple things in the chat, see if anything is a need. Question over payment. Mr. Washington, I believe you just answered that question. There you go. All right. Anybody else want to ask any questions before I move on for the next segment of this presentation? We are flying through this. This is awesome. All right. All right. So let me go ahead and pull up the next one. This is brand new. This is the first time I presented this. The math and everything for this presentation was just completed today, so bear with me. This is the first time I've ever presented this one. All right. All right. So this is specifically, there's something that we did a while back on, I think it was on one of the national calls. We talked about capturing taxes and how to do it. So this is a complete scenario that I've run where we know the numbers and there's some assumptions we're going to make. We're going to talk about that, but this is about how do you capture your taxes. And for everybody out there that's a 1099, this is something you should very, very much have in place for yourself, because if not, you're wasting a lot of money. So here we go. So for paying taxes with or without a debt-free life program in place, here's the impact. The first is when you pay your taxes, as soon as you write that check, that money's gone forever. That's a standard concept we have in debt-free life. The idea is we want to capture and sequester cash as early as we can, as frequently as you can. When we look at different ways that people are taxed based on the federal income tax brackets, which are getting ready to change, by the way, a person who files singly, if they pay $100,000, if they made $100,000 of taxable income, they're going to owe $24,000 in taxes. If they're married, they're going to owe $48,000. If they happen to be the head of the household and they're only making $150,000, they're going to owe $36,000. The point is that with all these taxes, once you write that check for $24,000, $48,000, or $36,000, the money's gone forever. But if you sequester that money into a debt-free life program, you're going to capture, as a $100,000 earner, $24,000 in taxes. You're going to capture $21,600. $43,200 if you're married, paying $48,000 a year, and $32,400 if you're paying $36,000 a year. So if you were given the option to pay your taxes, not owe anything, and have nothing left to show for it, or pay your taxes, not owe anything, and then have $21,600 stored in a bank earning money for you for the rest of your life, which one would you choose? Right? I see Martin gets it. He's laughing. You understand? It's a no-brainer, right?
Need the money.
Right. Take the money, right? So let's dig a little bit deeper into this. So here's the current federal income tax brackets for 2021. And this is where I was getting those numbers: 24%, 32%, 22%, and so on. So the amount of money you owe and the tax bracket that you're in is based on how much you owe, how much you made, and how you file. Are you filing head of household? Are you filing married separately? Are you filing married jointly? Are you filing as single? Okay. And there are advantages for each type of filing. I'm not going to go into that. That's between you and your CPA. Okay. So this is where the numbers come from. Everything that I'm done here today, I'm going to show you, it all is based on real hard numbers from the system. So let me do this. I can move you guys so I can see this. All right. So if a couple of key things to consider if we're trying to capture taxes. The first thing, if the only reason you're doing it is because you want to capture your tax income, when I mean doing it, I mean a debt-free life program, it cannot be the primary funding source for your debt-free life program. It can only be a funding source on top of whatever your core program is. You don't have a choice. If you make it the primary funding source, your debt-free life program will fail in year 2. What I mean fail, I mean you're going to be putting in more money than you, and you're going to need to take out more money than you're putting in. Okay. Here's another issue. When you put in the money in order to make the program fly, you can tweak it and get down to maybe 6%, maybe 7%. I just like to use 10% as a ballpark number that's protective and it works. If you're using a debt-free life program to capture taxes, the amount of taxes you need to pay, whatever that number is, you need to add 10% of that. And that's what you need to be sequestering into your account. Okay. I'll show you the math in just a minute, how it works out. This is not for people that are W-2, W-4s. This is designed for people whose primary income source is a 1099, or for people who have a W-2, W-4 job, but also get a 1099 from that job for extra commissions earned or bonuses, or maybe have a side hustle where they're on a 1099. Okay. And I'm going to use this, tonight's presentation. This is specifically developed for us. This is specifically for Symmetry agents. So you should know how to use it. Okay. So I'm using an insurance broker as the example. The person that we're going to use is a head of household filer making $150,000 of taxable income per year. That does not mean you're only making $150,000. That means maybe you made $225,000, but you've got $75,000 of expenses that you're going to write off. So your taxable income is $150,000. And if I speak and you already know what I'm talking about, I'm not trying to talk down to you. I'm just saying some people don't know how that works. So I'm showing you how it works. So in the scenario we've got, head of household claimer, $150,000. That puts that individual into a 24% tax bracket. The amount of income they owe on 24% is $36,000 per year. When we look at this, if you are in your second, third, fourth year, whatever in this business, you need to be not paying annually your taxes. You should be paying quarterly. Okay. So if I look at a quarterly amount of $9,000, that's 1/4 of 36,000. That means every quarter I'm stroking a check to the IRS for $9,000. If I'm going to use a DFL structured campaign for this, then I need to be paying $3,300 a month. That's that 10% extra on top that I talked about earlier. $9,900 a quarter divided by 3 months, $3,300 a month. Okay. That is $3,300 a month, 100% PUA. It cannot be a portion term, a portion whole life, and a portion PUA. It is 100% PUA. So that's why I'm telling you, this is on top of whatever your core policy requires. Okay. So that last statement, again, I'm driving this point home. Your paid up edition bank must be able to hold $39,600 per year extra on top of the normal core policy PUA amounts. I'm going to show you what I mean in just a second. Let's move on to the next screen. And here's what I'm talking about. So this is an illustration for this person that I use, a 42-year-old insurance broker, good health, non-tobacco. This person is basing a core policy on $500 a month. Of that $500 a month, if I do the annual numbers, $2,400 a year, which is $200 a month, is going into paid up additions. That's that $2,400 down here. And the balance, $300 a month, is paying the core policy costs, that term and whole life. Okay. You'll notice, remember I said it has to be able to collect a total of $39,600 more than what the base is. The base, if all I do is pay my $500 a month premium, the way this one's structured, I'm going to be paying in $2,400 a year. On top of that, I will be able to collect $48,423 minus $2,400. My bank will be able to hold an additional $46,000. That is enough to capture my taxes of $39,600 that I'm going to be adding in to use this as a tax program. Okay, moving on. Dollar cycling. If you are dollar cycling, your program's going to fly. If you're not dollar cycling, your program's going to stagnate. When I mean by dollar cycling, I mean you are actually going in every month. You're putting in PUAs. Maybe you reach your ceiling, maybe you max out your program, maybe you don't. But either way, you're building more bank capacity so that you're using more loans, building more bank, using more loans. So you're cycling through those dollars over and over and over. Okay. The core policy, the term and whole life, that portion of the core in this scenario, that $300 a month for the whole life in the term, that's paying for the maintenance of the program. Okay. The extra $200 that I've got from my 500, remember, this is a $500 a month core policy premium. That extra $200 a month is building more PUA. Okay. Now look, I'm not saying you don't do this in conjunction with a normal debt-free life program. You certainly can. I'm just showing you these are the specifics that you have to do in order to have your taxes run through the program so that you can get that cherry or that pot of gold at the end of this rainbow that I'm going to show you in just a minute. If you do this program just based on the additional money, that $39,600 per year, to allow you to pay that $36,000 a year in income taxes. If you do that, the earnings that you're going to make on the first year is $1,440. Okay, couple of things. These numbers, this is simple straight interest. It's not compounded. It does not include the dividend. So these numbers are the lowest possible. These are the minimum numbers that it's going to be. This is the worst case scenario. Okay. In year two, because you're putting in an additional $39,000, plus you've got some compounded interest. The only compounded interest I'm using, just FYI, is the $1,440. Okay, so in this scenario, year two, you've got $3,231 that you made. Year three, again compounding, $49.45. Year four, $67.26. Year five, $87.99. That's the guaranteed interest that you made. That's it. It doesn't include the dividend. And it only includes a portion of the compounding. That's great. Okay. Simply by making my taxes payment to my debt-free life program in year three, I'm putting in enough money that the program is a positive program. I'm getting out $49.45. I'm putting in an additional 10% of $36,000, $3,600. So I'm a positive in year three. Okay, that's great. However, it's way better than that. Why? Because by the end of my fifth year program, I've sequestered $198,000 of additional money in my PUA. That $198,000, when I die, that $198,000 is actually life insurance. If I get to the point where all the debt's paid off, that $198,000 is $198,000 more that I have in my program that I would not have had if I did not do this. The program, as I'm illustrating to you right now, this is only a 5-year program. I am not planning on, with the illustration I'm showing you, I'm not planning on putting more money in after the 5th year. I would be foolish not to, but for the purposes of illustrating just what 5 years does for you, this is it. By the end of that 5th year, I've sequestered $198,000. I have taken $165,000 of PUA loans. So that means that, that 198 minus 165, that means I've got $33,000 to the good. What's $33,000? That's almost what I pay in taxes every year. So what I've done here is I've created a scenario, if I wanted to, where I've got an additional year's taxes already paid. And take a year off from paying taxes. Sign me up. Okay. What else did I do? Just through the course of dollar cycling, making my premium payments, making my 10% over what my tax payments are, making my $500 a month core policy premium. I've also paid off $21,000 of the loans that I took. So now how much do I have in my program? It's not 165. I've got 198,000 in the program, but I have $144,000 that's not encumbered. So what does that mean? Again, looking back at what I just said, that means there's enough money in the program and by the 5th year for me to pay my entire 6 years of taxes if I want to. And here's another thing. By the end of the 5th year, just through the process of compounded interest and the fact that I'm making my $500 a month payment, I'm going to be paying off $11,000. It's actually more than that, but it's $11,000 of that loan per year. So when I do that, every time that $11,000 gets paid off, it's either putting more money into the bank, increasing it by $11,000, or it's paying off $11,000 of my loan, creating more exposure to my dividend and a reduced amount of money that I owe in interest. Okay, and now for the aha moment. In the 5-year program, the net gain, minimum net gain is 70,000, minimum. Here's the truth. Your net gains after 5 years is 126,000. At the end of that 5-year run, the way I've structured this program, I don't do my tax payments anymore into this program because I'm foolish. Okay, I stop because or maybe I retire. Maybe I don't have tax payments anymore. In that scenario, after 5 years, I'm not making those massive payments into the program anymore, but the program is on automatic pilot. And remember, I've got a loan out, right? At the end of the 5 years, I've got a loan. It's about 144,000. But what happens is I get to realize more of my gain as that loan gets paid off. I'm getting more compounded interest as that loan gets paid off. I'm getting more dividends as that loan gets paid off. And as I go through the process, 10, 15, 20, 25 years, that's what my net gain is. That's true net gain. So you all should have had a holy cow moment just then. And then you should also be kicking yourselves in the butt. Why didn't I start one of these DFL programs last year and start paying my taxes into it? Well, you didn't know about it. And that's the end. So I'm going to open it up. Who's got questions? So real estate agents would be great. Yeah. Yes, Laureen. Anybody who's on a 1099, real estate agents, mortgage brokers, bankers, certainly anybody in the insurance industry, financial planners, all those people would be prime candidates. And the financial planners, unfortunately, they're probably pompous enough that they won't listen to you, but that's their problem, not yours. And since there's no more questions, thanks for coming.
Hey, Scott.
Oh, hey,
Thanks for taking
Brandon.
my question. Yeah. So you got the mortgage. Do you split it up between the husband and wife policies and one car on each, or stack all the debts on one policy and then kind of just write a simple whole life on the spouse?
You asked a lot of stuff there. I'm not sure what question you're trying to ask. Please try it again.
Do you take the household debt as a whole, and do you split it between, let's make a DFL bank for one?
All right. So, hold on. So you're talking about specifically a debt-free life program, not one of these programs for taxes.
Right. Yeah. Not the
so on a
tax,
debt-free life program, there's a financial analysis form that you should fill out. There's no reason not to incorporate all the debts onto that program. If you have a husband and a wife and they're both earners, there's no reason not to write 2 programs on them. If the program is large enough, has enough PUA in the beginning to be able to hold what you need, usually about year 2 or year 3, it's going to expand beyond the point where your PUA bank is going to be able to capture everything you need. And it's going to show you that you need to start putting money in a savings balance or a savings account. At that point, if you wrote a second program, which is what I do all the time, you write a second program on the other spouse, and it's usually a term program that's convertible. So you write the term, it's fully underwritten, you go through underwriting, get it approved. And then when it comes time for you to convert that fully underwritten term program into another participating whole life program, call the carrier, do the paperwork, flip it on, and now you've got 2 separate DFLs running at the same time. If you have families that where both of them are earning about the same, then you may want to forego what I just said, and you may want to do 2 DFL programs at the same time on day one. And that's fine. It's personal preference. There's no right or wrong. If I have an opportunity to write a term versus 2 separate DFLs, the term is going to be more efficiently spent money. Okay. And I'm going to go through underwriting now so that they can't be declined in the future. So I'm going to go ahead and write that term. And then when the first bank maxes out, I'm just going to pick up the phone, flip the switch and turn it on. Okay. I don't see anybody else unmuted. I don't see any other questions. Oh,
Hi,
there's
Scott.
Zulma. Hi, Zulma.
Hi, I have a question. To set up the taxes for the DFL, so in year one, this person made 150,000 as taxable income. But what about in the next year? Let's say they make a little bit more money, they make 200,000. Are they able to, do they have to get a separate DFL for that? Or for that increase, or can they?
Let me ask you a question. Are you ready?
Mhm.
That first DFL, did you plan for having an increase in income in your second year?
Okay.
Right.
Oh,
So
yeah.
this is when we're looking at DFL programs and planning them out, you need to be a bit of a soothsayer, and you need to look into the future. So you need to, not only if it's a traditional DFL where you've got a debt snowball that's rolling and you can see when the snowball happens, you need to take that in consideration. Okay. And you may need to start 2 DFLs. You may need to have one waiting in the wings. I don't know. Everyone's unique, but I would say that you would want to make sure that you're prepared for that. So that's why whenever I'm doing these things, I'm always, if you're not doing it for death benefit, which most of the time we're not, then all I'm doing is I'm absolutely maximizing the term that the thing can have. So that gives us the most amount of bank we can have based on the premium they want to spend.
Okay, but the term wouldn't give you the cash value though, wouldn't that be with the
It
whole
isn't,
life?
it won't, but it will give you the capacity for cash value. As the term umbrella gets larger, the amount of cash you can grow underneath it gets larger. That's what the term is there for. It's there to shield so the IRS can't see how much cash we're building underneath. Okay. That's the purpose of that term. Right. So
Okay.
you want, I'm not doing it for death benefit. I mean, permanent death benefit, whole life. I'm doing it for the bank. If I happen to have a client that I am doing it for the death benefit where it is a concern, that's a different conversation. Okay. So this is where you get to play with it. You get to tweak it. This is the
Okay.
fun part. That's playing with the numbers.
Okay, perfect. And
Yeah.
then this is being recorded. Will you upload it to Slack later on? So you
It
can
won't
pass
be
it
in
on?
Slack. It'll be up on YouTube later on this afternoon. I'll put the link in Slack. Yeah.
Okay, perfect. Thank you.
Okay. Mr. Deutsch, you got anything to add, sir?
No, I just wanted to say how thrilling it was to retire one of my $18,500 credit cards this week.
Woo! Right on,
Yeah,
Tommy D. You're helping
nice.
with that
And
1
it-
trillion.
and it wasn't that painful to build it up to that. So
Right.
if you haven't done one of these on yourself, I highly recommend it. Now I'm going to get to see things begin to spin faster.
There you go. Yep. Now the snowball's rolling.
Exactly.
Now-
And I love the tax advice. Well, not the tax investing our tax dollars for ourselves.
Yep.
Love that plan.
Yep.
Be implementing that too. So
Yep. Awesome stuff, man.
great. Well, listen, thanks for taking the time out again tonight, Scott.
All right.
Always appreciated.
Well, I
And,
appreciate you, Tom.
and we've got another special class coming up in about 15 minutes, don't we?
Yep. Jamie McCrae is going to be teaching an annuities class for those of you. Jamie Satterfield is going to be teaching. You're about brewing, right? You're teaching a class on brewing.
Yeah, I'm not
Beverages?
teaching. I'm not taking. I'm not teaching anything. I'll be drinking things.
As long as you got a plan.
Right.
Hang on just 1 second.
All right. Well, thank you everybody for coming. Hopefully you got something out of this. Please talk to your upline if you have questions about DFL and about writing them and want to get certified and appointed to do so. And if you are not an agent and you were here simply to experience DFL and see what it's like and what it's all about, please get with whoever invited you and look at doing one of these programs for yourself. It's the hottest thing going. If you want a little bit more information, Bloomberg did a story about this about 3 weeks ago. It's about infinite banking. So welcome to the party. All right, bye everybody.
Thank you,
Thanks,
Scott.
Scott.